All right, so today I wanted to talk a little bit more about dividend investing. This is a way of investing that's gotten, I mean, it's always been popular, but it's gotten more popular over the last few years. And in some ways it's good, in other ways it's not good. And I think people make a couple mistakes. But the first one would be, and most obvious one would be, is buying companies with really high dividends that haven't been able to maintain their share price over time. The most common or the easiest example of this, QYLD, right? This is a covered call fund. This isn't an actual stock, so this is an ETF. They simply sell covered calls, right? But if you look over time, the share price has gone down, right? And very significantly as of late. And it hasn't recovered all that much recently. So again, it has a almost a 13% dividend, but again, you're consistently losing value as far as the share price goes over time. So the first thing you want to look at if you're going to invest into one of these ETFs or stocks that has a very high dividend is check the share price, because if the share price is going down, it probably means you're going to get killed, right? You're going to get burned, right? Another example of this is Annaly Capital. They're a BDC, I believe. Again, 17% dividend. But again, if you go back, let's just go back 10 years, just for sake of argument here. Again, consistently falling share price. Even if we go back 5 years, again, consistently falling share price. So again, you got to really keep an eye on this stuff. Now, again, if it's going down 1% per year on average, I wouldn't be overly concerned. But again, if you look at this company 5 years ago, or 5, 6 years ago, $40 a share. Now it's at $21 a share, right? So it's lost almost half its value just in 5 years, right? So you got to be really careful with this stuff. Another common one right now is Zim. It's a shipping company. Its share price is actually, I mean, it's only been around for looks like January of 21 it came out. So not even just over 2 years. Its share price is actually basically slightly up over that time, although it is down a lot over the last year roughly. So again, this isn't one that over time has lost a ton of value. But the other thing you need to keep in mind is the dividend that these companies are paying, is it sustainable, right? Is it sustainable, right? I'll give you a better example of this. Actually, let's check it. Let's check it. See how good of an example is here. There may be a better example that I'm thinking of if we can get it to load here. All right, so it has consistently been paying a dividend, but keep in mind it came out just in 2021, which was pretty much the perfect time for a shipping company to start operations. I'll give another example. DHT Holdings, they are a tanking shipping company. And if you look at their dividend over time, it's all over the map, right? Now, honestly, over the last, looks like 4 or 5 years, it actually has been pretty good, and it's been insanely good at certain points in time. I mean, looks like it's been over, it's been in the double digits for the majority of the time. But my point here is very simple. The shipping business is very, very cyclical, right? And a lot of these companies, you can go from a 10, 20% dividend to a 0% dividend overnight. And on top of that, you can have a falling share price. So what I personally want to look for when it comes to dividends is stability, right? Because a dividend is meaningless if it's not stable, right? So again, just some personal examples. Ares Capital, as far as BDCs go, BDCs are very common for high dividend investors because they are regulated kind of like REITs are. I don't know the exact details of how they're regulated, but they have to pay out very high amounts of their earnings as a form of a dividend, right? So they're always going to have high dividends. So again, you want to look at consistency of the dividend. Again, Ares Capital, again, it's actually gone up a little bit over time, but again, never had a dividend cut over the last 10 years, right? one of the easiest ways to tell is, number one, how long has the company been around? If it's been around for a while and it's never cut its dividend, it's most likely safe, right? Most likely safe. So again, as far as this goes, Ares Capital's dividend looks pretty safe. Not 100% because there's no guarantees as far as these goes, but again, it is pretty safe. Let's look at the share price. Again, share price over time, pretty steady. Actually, it's gone up slightly. But again, it tanked very hard in 2008. But again, if we go back 10 years, share price 1777. Today it's 19.6 roughly. So again, it has gone up slightly over time, and you're getting a 10% dividend, right? Other examples, let's just go Alliance and Bernstein. Again, look at the share price. Again, it's going up over time. If we look at the dividend, again, it is going up over the last 5 years, which is good. Payout ratio is high but safe. So again, those are the kinds of things you want to keep an eye out for. Again, if you have a REIT or a BDC that has a high payout ratio, I wouldn't be super concerned with that because they have to pay out very high amounts. If you're looking at stocks, you definitely want to be concerned with very high payout ratios. Honestly, this is bordering on concerning if you ask me. But again, if you're paying out a very high dividend, you're going to have a very high payout ratio. What is the best way of investing as far as dividends go? In my opinion, it's buying companies that have lower dividends but are growing them faster, right? You know, if we look at, let's look up an example. There's many examples of this here, but if we look up Canadian National Railway, let's just look up them as an example, right? If we look at the dividend yield over time, let's go back here. Historical yield on cost, right? This is what we want to look at. So again, they're a company that's growing their dividend every single year, right? Every single year they're growing it. They're growing it at 12% per year over the last 5 years, right? And if we go back 20 years, exactly, you'd have a 30% dividend yield, right? A 30% dividend yield on cost, right? If we go back 10 years, we're looking at about 7%, a little over 7.5%. So in my opinion, these are the kind of companies you want to buy because if they have a dividend that's going up every year, number one, if you buy it today, your dividend's always going to be higher over time. And on top of that, you're going to be able to absorb that share price increase over time. Because at the end of the day, if you have a company that has a 10% dividend yield but no share price growth versus a company that has a dividend that's going up at 10% a year with 5% a year share price growth, well, that the latter is going to be better off, right? So that's the point I'm trying to get across here when it comes to dividends is when you see companies with very high dividends, chances are it's not sustainable. And the way to know is, have they had dividend cuts in the past? Number two, is it a cyclical business? Because again, shipping is a good example of this. Very cyclical, which means you're not going to get that dividend for the rest of your life or even the next 5, 10, 20 years. Not going to happen, right? At least most likely. So again, that's another thing to keep an eye on. Payout ratio. Again, is it a cyclical business? There's many ways of telling this. The other reason why I like this form of investing is because it's a lot easier to predict this kind of stuff. It's easier to predict. Again, if you look at a company like Canadian National Railway, they are going to be around in 10 years and they are going to grow. Is a shipping company, are they going to be around in 10 years? Are they going to have grown? Nobody knows. Chances are they'll be around, but are they going to be? Is that dividend still going to be there? Are they There's a lot of unknowns there, right? Some of these BDCs, some of these mortgage REITs, right? You got to be, and it's not that they're all bad because there is some good ones, but you got to be very vigilant and don't be sucked in with the high dividends. What sucks me in and what I think should suck other people in is a company that is growing and is growing that dividend at 10, 20% per year. That's what I look for, right? And again, if you look at the companies that I've talked about, again, EQB, Visa, like these are examples of that, right? Companies that are growing their share price over time, they're profitable, they have a good moat, and they're growing that dividend, right? Those are the kinds of companies you want to look for, right? So again, I'm going to leave it there. If you like the video, hit that like and subscribe, and stay tuned for more.